Welcome to the Explainer. So, if you've been watching the tape lately, you've definitely seen the headlines. Nvidia writing these massive checks to help Corning build out optical manufacturing right across the US. Now, the amateur tech bloggers, they're out there geeking out over fiber optic specs and heat dissipation, but we're going to completely bypass all that noise today. Because honestly, if you only focus on the engineering, you completely miss the brilliant, frankly ruthless capital reality of what Jensen Huang is actually doing here. This isn't just your standard supply chain partnership. We're looking at an absolute masterclass in capital strategy.
For any private equity partner evaluating long-term portfolio risk, or really any serious institutional investor tuning in, you have to look past the silicon and face a single, chilling question. The conventional wisdom is always, whoever builds the fastest chip wins. But what happens when computing power is no longer the primary barrier to entry?
It really comes down to this idea. Nvidia didn't just secure supply, it removed the market. That is the absolute reality right now. This massive influx of cash to expand US capacity isn't just about making sure Nvidia has enough glass for itself. It's a cold, calculated hit job to lock down priority access, fundamentally stripping competitors of their ability to scale their own operations. They are literally taking the market off the table before anyone else can even place a bid. Let's tear down this illusion of technology just being about smart chips and look at the infrastructure bottleneck, the actual physical battlefield where this war is currently being waged.
We have to recognize a fundamental baseline reality here. The first phase of the AI arms race, it's completely over. The days of battling over chip node sizes and fighting for TSMC fabrication capacity, that's yesterday's war. As AI superclusters grow to these astronomical, unprecedented sizes, compute is scaling way faster than data can physically move. So, the physical bottleneck of the entire industry has shifted completely away from the chip itself and directly onto the transmission speeds inside the server rack.
And here is the physical limitation of our current hardware. Traditional copper wiring is hitting an absolute thermal and latency wall in these massive high-heat data centers. Copper is failing. The only path forward is optical connectivity, which relies on incredibly precise specialty glass. Because copper just can't handle the load anymore, this specialized glass has become the ultimate physical constraint, making control of this specific physical layer the absolute holy grail for institutional prizes.
Which brings us to the capacity strangulation. Securing this specific physical layer is exactly what enables a multidimensional strangulation of any potential rivals.
You see, a lot of people think Nvidia is out there trying to buy every single piece of glass in the world. They aren't. They're executing what we call bottleneck priority. In a physically constrained system, holding the prioritized access is infinitely more valuable than just hoarding absolute supply. Nvidia is securing the priority access to the most strategic layer of the supply chain. They get to dictate the terms, the pricing, and the timing for absolutely everyone else in the market.
This creates a pretty horrifying reality for competitors. Think about it. Nvidia has locked in, prepaid, immediate priority. Meanwhile, rivals like AMD or Intel are staring down delayed, uncertain, and highly restricted capacity in the optical supply chain. Let's do a quick thought experiment. Say in 3 years, a competitor designs a chip that theoretically matches or even beats Nvidia's hardware. Well, it actually won't matter. They'll be horrified to discover that when they go to string those chips together into a supercluster, the optical capacity to actually link them physically just does not exist for them.
It's actually a fascinating historical echo. Back in the 1870s, everyone was fighting over digging oil wells, right? But John D. Rockefeller crushed the competition by quietly monopolizing the rail lines and the oil pipelines. He didn't care if you had oil. If you couldn't move it, your oil was worthless. Fast forward to the 2020s, and Jensen Huang is playing the exact same game. Nvidia is monopolizing the physical data pipelines, the specialty glass and optical transmission of the AI era. Your chip is worthless if you don't have the pipeline to move the data. Now let's talk about capital allocation and ROIC. Because for the institutional investors and PE folks out there, the true beauty of this maneuver isn't just the supply chokehold, it's the textbook execution of capital allocation.
Look, Nvidia could have easily decided to build its own glass factories, but doing that would mean falling straight into the heavy asset trap. They'd bear all the construction risk, the massive depreciation on their balance sheet, the labor costs of thousands of specialized workers. Instead, they used external leverage. They use their massive cash pile to make prepayments, effectively forcing their partner, Corning, to shoulder all the physical construction risks, the depreciation, and the labor management right here on U.S. soil.
This aggressively protects Nvidia's return on invested capital. By utilizing these massive prepayments and leveraging an external partner's balance sheet, they're building an impenetrable internal moat. They entirely avoid fixed asset depreciation. They lock in priority at a remarkably low capital cost relative to their size. They are maintaining an astronomically high ROIC without diluting it through risky, heavy hardware infrastructure investments. Honestly, it's a textbook masterclass.
Let's translate this brutal, physical chokehold into the exact language Wall Street models actually care about: free cash flow certainty.
The institutional logic here is a straight line. You secure priority over the optical bottleneck, which naturally caps how fast your rivals can scale. That effortlessly extends your own window of absolute market dominance, and finally, it eliminates future cash flow uncertainty. Nvidia isn't just selling chips today, they're buying future competitive space and locking in their future revenue streams.
When Wall Street fully realizes that challengers are physically locked out of the infrastructure for the next 3 to 5 years, what do? They slash the risk discount rate applied to Nvidia's future cash flows. Less risk justifies a massive conceptual institutional valuation premium. They're practically pricing in a 100% guarantee of competitive stability.
But we have to look at the antitrust and disruption risks. Because as cold-blooded analysts, we know this perfect moat is not invincible, and we really need to stress test the structural risks holding up this portfolio.
The sword of Damocles hangs over this entire strategy. Let's look at the threats. First, fierce antitrust scrutiny. Locking up a market's capacity like this is a giant red flag for regulators. Second, expect competitor coalitions to form, actively demanding regulatory intervention. Third, and maybe most dangerous, are technological shifts. If a sudden disruption occurs, say the emergence of non-glass crystal materials that bypass this whole process, well, these massive long-term prepayment contracts could turn into toxic stranded assets overnight. And finally, do not underestimate mega buyers, those massive cloud providers, deciding to regressively fund second-tier alternative supply chains just to break Nvidia's grip. So we're left with this final, provocative thought. Nvidia has successfully welded a steel plate over its intrinsic value by monopolizing this bottleneck. They aren't just scaling AI, they're defining the strict physical conditions under which anyone else is allowed to scale. But the ultimate question remains: how long can one single company dictate the physical expansion of an entire global industry before regulators or a sudden leap in disruptive physics step in and completely rewrite the rules of the game? It's a risk you absolutely must price into your long-term outlook.
And finally, as we wrap up, please note this brief disclaimer. This explainer explores long-term capital strategy and fundamental business review based on qualitative public supply chain trends. It does not constitute financial advice, trading instructions, or a recommendation to buy or sell for your portfolio. Always do your own thorough research. Thanks for joining me on this deep dive into the real mechanics of market power. Keep learning, keep questioning, and I'll see you in the next explainer.